Hello everyone. We'll see the further topics in today's video. So the next term is domestic income. Okay, it is really very important. Domestic income is also known as NDPFC. Okay, net domestic product at factor cost. So now, uh, by definition, we will see what is domestic income. It is the sum total of factor incomes generated within the domestic territory of a country, no matter who generates this income, whether it is a resident or non-resident, doesn't matter. Okay, like see, we'll see with the help of an example. Suppose this is an this is our India. Okay, there might be few people who are from uh, outside India, from US, Canada, China, Japan. Okay, and there might be Indians as well. Okay, so these circle ones are the foreigners, means non-resident, and these triangle ones are the Indians, means resident. So within this territory, within this our domestic territory, the people who are residing in this area, okay, the income generated by these people, whether Indians or foreigners, doesn't matter. So the sum total of all the factor incomes generated by these people within the territory, okay, it will be called domestic income. Clear? Okay, so it means it is the sum total of factor incomes generated within the domestic territory. Okay, this is domestic territory, no matter who generates it. Okay, whether it can be a resident, means the citizen of the country, and it can be non-resident, means the outsider, the foreigner. Okay, so in domestic income, the main focus is on the place where it is generating, where the income is being generated. Okay, the focus is on place, on the territory, when we say about the domestic income. Okay, now example, इंडिया के अंदर रहने वाले लोगों ने जो पैसा कमाया है. ओके, सो पीपल लिविंग in India, whether they are the Indians or whether they are the foreigners, doesn't matter. But if the people are earning money inside India, that income will be called domestic income. Okay, like profits earned by a branch of a foreign bank in India. Profits earned by a branch of a foreign bank in India, means there is a foreign bank, say HSBC or American Express. So they are located in India. They are generating, they are earning money in India. They are earning profit in India. Okay, but that bank is outsider bank. Okay, but that bank is generating money in India. So the money generated by that bank will be known as the domestic income. Okay, rent received by a company in India which is owned by a non-resident, means there's a company which is owned by a non-resident, means by the foreigner. Okay, for example, an American person owns a company in India. Okay, and that company, rent received by a company in India which is owned by non-resident, that uh, American is running a company, okay, in India, and that company is receiving rent, okay, from from the property or from the services, any. So that money is earned by the foreign company, but that foreign company is located in India. Okay, so that money will be called counted in the domestic income. Okay, and this domestic income is also called NDPFC. Remember this is the aggregate for the domestic income. Okay, now the second thing is national income. It is also called NNPFC. It is a sum total of factor incomes accruing to normal residents of a country, no matter where the income is generated, within the domestic territory or rest of the world. See, in domestic income, I said the main focus is on place, the okay, where the income is generated. Okay, here in national income, the main focus is on person who is generating that income. Okay, okay, so in domestic income, main focus was on place, okay, where the income is generated. In national income, the main focus is on person who is generating. So like this is India, these are the Indians here. Some Indians might be living outside India, might be earning there. Okay, so income of the Indians, okay, like India is, we are Indians, we are calculating the national income of India. So that's why I'm calculating Indians. Okay, I'm counting Indians. So Indians living in the country and Indians living outside the country. Okay, so income earned by the Indian living inside the country and living outside the country. So all the income will be calculated, will be counted as the national income. Okay, here we will subtract the income who are, which is generated by the foreigners. Okay, because we are paying them, India is paying them money. Okay, so we will not calculate that. Clear? So we will calculate only that income which is earned by the resident or the citizen of the India. Okay, whether that Indian is residing in India or residing outside the India, doesn't matter. But main thing is, it the income must be earned by the resident. Okay, so that's why I said earlier the main focus is on the person who is earning money, no matter where it is earning, inside the territory or outside the territory. Okay, इंडिया के अंदर एंड इंडियंस जो बाहर रहते हैं, दोनों ने जो पैसा कमाया है, दैट इनकम इज कॉल्ड national income. Okay, example, let's see. Salary received by an Indian employee working in Japanese embassy in India. Okay, so an Indian employee is working in Japanese embassy. Okay, so that income, that salary, who will give the salary? Japanese embassy will give salary. So that person is receiving money from the foreign person, foreign entity, foreign institution. Okay, but he is earning money inside the India. Okay, or we can say he is receiving money from abroad. Okay, so but the main thing is the employee is Indian. Okay, no matter where the this Indian is earning money, whether it is in India, whether it is outside, doesn't matter, but main thing is Indian is earning money. So that income will be considered in the counted in the national income. Second, profits of a branch of SBI in England. Okay, so there is a bank SBI in England and that SBI is earning profit. So bank is Indian. Okay, but that bank is situated in the England. That is the SBI is the property of India, but that bank, that branch is located in England. So that profit will be counted in the national income because that bank belongs to India. Okay, so how we will calculate national income? The domestic income plus NFI, net factor income from abroad. Domestic income means income earned within the territory plus income earned from outside the territory. Okay, we will add these two, we will get the national income. Sometimes in paper, in exam, while doing numericals, NFIA might not be given directly to you. Okay, so there is a formula for this NFIA: factor income earned from abroad minus factor income paid to abroad. Okay, so we are adding the income which is earned by the Indians from abroad, but we are subtracting the income which we have paid to abroad. Okay, means few people might be living in India, few foreigners, they are earning money, okay, from India. So we are deducting their salary but adding the salary of Indians who are working abroad. So in exam, NFIA might not be given to you directly. So what you will do, you have to search for these two things: factor income from abroad minus factor income to abroad, and we will get the NFIA. Okay, factor income from abroad minus factor income to abroad, we will get NFIA. Then we will use NFIA in numerical. So these are the two things which are really very important for exam. Okay. Now second thing is gross and net. See, there's the formula starts from here. The main basic formulas which we will use in the upcoming session while doing numericals. So the first conversion, there are three basic formulas, three basic conversion of the formulas. Like in childhood, and when we were in first, second, third class, we used to convert the grams into kg, meter into kilometer. Okay, so in the same way we have to convert these things. Okay, now how we will see, we'll convert. Let's see, there are two things: gross value and net value. Okay, gross value and net value. What is gross value? It is the market value of final goods and services produced within the domestic territory during an accounting year, including depreciation. Okay, so when we add depreciation we get gross value, and when we exclude depreciation we get net value. Clear? So how we will convert? We have to convert gross into net. Okay, so we have to convert gross into net. So what we will do, we will subtract depreciation. Okay, we will subtract depreciation, and we have to convert net into gross. What we will do, we will add depreciation. Okay, so when we have to convert gross into net, we will subtract depreciation, and we have to when we have to convert net into gross, we will add the depreciation. Okay, why? Because we are converting net into gross, and to calculate gross we have to include the depreciation. Okay, see, this is how we write GDP MP, GNP MP. Okay, this is the way of writing the aggregates. Okay, gross domestic product, net gross national product. Okay, like NDP, net domestic product, NNP, net national product. So this is the way how we pronounce these aggregates and how we write these aggregates. Okay, now the second thing is domestic and national. In the previous slide we have seen these two terms, domestic and national. So what we will do, if we have to convert domestic into national, we have to add NFIA. We have seen this earlier. And if we have to convert national into domestic, then we have to subtract the NFIA. Okay, these are the basic conversions which we have to remember. While these direct questions will not be given from these, but it will help you in conversion, in finding out the answer. Okay, so to convert gross into net, minus deb; to convert net into gross, plus deb; to convert domestic into national, plus NFIA; and national into domestic, minus NFIA. Okay, now there are two more things: factor cost and market price. Okay, what is factor cost? It is the cost of production. Okay, गुड्स बनाने में जो खर्चा लगता है. Okay, like if I am producing a packet of biscuit. Okay, so then if I am selling that packet at rupees 10. Okay, so I will be producing it at a cheaper rate. Okay, like I am producing it at 5 rupees and I am selling it at 10 rupees. So what will be my production cost? It will be rupees 5. And what will be my market price? It will be rupees 10. Okay, so the price at which the producer is producing goods, it is called factor cost. Okay, and the price prevailing in the market, the price at which goods are being sold in the market, that price is called market price. It is simple. Okay. Now, if we have to convert factor cost into market price, okay, if we have to convert factor cost into market price, what we will do? We will add NIT. Okay, what is NIT? Net indirect tax. Okay, and if we have to do the reverse thing, we have to convert market price into factor cost, we will subtract the NIT. That's it. Okay, so from FC to MP we will add. From, if you go to reverse from the market to the factory, then what we will do? We will subtract the NIT. Okay, and what is NIT? Net indirect tax. Sometimes NIT might not be given to you directly. You have to find the NIT. So how you will find? There's simple thing here. Indirect tax minus subsidies. These two things will be given to you. Indirect tax minus subsidies. Okay, so by subtracting these two you will get NIT. Clear? So these are the basic formulas, basic conversion which we will be using while solving the numericals. Okay, we'll see the numerical part, the basic conversion part in the next video.